Welcome to Livewire's latest expert insights. Today, we're going to be chatting with Robert Pointer, Head of US Research at BGI Partners. Over the course of the next 30 minutes, we'll be chatting to Rob from his New York office about his current thoughts around the US market. We'll be looking at whether investors should be concerned by the current flurry of IPO and SPAC activity within the markets. And we'll also dive into his thesis of an ASX-listed company recently added to the portfolio that he thinks is worth a bet. So Rob, you've been living and working in New York throughout the COVID-19 pandemic. What's your current take on the state of play in markets? Are you pretty optimistic?
You know, we're seeing some pretty interesting cross currents in the market over here and I think globally. Whether that be, the havoc I think that we saw last year with COVID, closing down, both the US and many economies around the world, and that resulting in, unemployment rates we haven't seen since the Great Depression here. The other factors I think that have been pretty important, not only through COVID, but certainly over the last numerous years, has been this ongoing polarization of political views in the US. That's been sort of a factor that we talked about in the letter that I think is becoming increasingly important. And then the other thing that we've seen over here is this ongoing wealth disparity, and that's something that has been building for many years, if not decades. And certainly, when we look at the earnings power of labor in this country and on an inflation adjusted basis, it's been going backwards. So that's kind of some of the, I think some of the challenges that, both here and globally that we're facing. But I guess on the other side of it, as we know, there's been this very real and pretty extraordinary monetary and fiscal stimulus efforts. And so, we've seen things like wage replacement schemes. We've seen, not only historically low interest rates, but the promise of historically low interest rates for many years, and then this kind of wave of liquidity through central bank money printing, which certainly at the moment seems to be limitless. So it's certainly seen these cross currents at the moment, and I think on top of that, we are starting to see some pretty clear pockets of frenzied speculation. I think that it's pretty hard to deny that we're seeing some of that in the market. And one area that we talked about in the letter, is this SPAC market, these blank check companies where investors are essentially parting with their cash before knowing what they've actually bought. And that's a market that exploded in 2020. We saw in 2020, that SPAC market raise almost $80 billion in proceeds. And, just to give you a sense of how large that number is, that's a six-fold increase on the year before. And if you look at the IPO market, not just for SPACs, but all companies, the amount that was raised last year was greater than the total IPO proceeds of 2018 and 2019 combined. And, we've actually seen that accelerate in 2021. So year to date, just in the last few weeks, we've seen a further $20 billion raised in that SPAC market. And so, if anything, that seems to be accelerating. So, there's definitely, I think, some pretty clear signs of excess, but, conversely, at BGI, we're not ones to forecast markets and certainly not ones to make bold predictions about the market. I think no one knows what's going to happen over the next 12 months. And, if we ever needed proof of that, I think 2020 was the great example where anyone who, made a prediction at the beginning of 2020 was proven pretty wrong. So, what we're very focused on is, our process, our research process. We try to be patient, we try to be prudent with our capital, and then we've got to move decisively when those opportunities present themselves. So, despite the environment, the last 6 months for us has actually been, one of the most prolific periods, I'd say, in terms of new idea generation that we've had in many years. So, there's a number of cross currents in the market, but I think from our perspective, we've just got to stick to our research process and look for opportunities.
It's actually really interesting that you mentioned the flood of IPOs and SPACs into the market. I think I read a stat the other day on the Fed that said that current US household exposure to equities was around 41%, which was just shy of the record. I think it was 47% during the tech wreck. Do you think investors should be concerned?
It's certainly it's a signal. I think the household ownership of equities in itself is not necessarily a strong indicator of speculation. I think probably the more troublesome trend that we've been seeing is this, I don't know, you call it gamification of equity trading. And, there's been a number of factors that I think has driven that. I think certainly here in the US, you've seen this proliferation of commission-free brokerage services. And then, but the more troublesome thing, I think from our perspective is, if you look at some of these apps that these, retail brokers have put to market, it's very difficult to ascertain the difference between these apps and a sports betting platform, or even, online casino games. They're designed to create some of the speculative behavior that we've been seeing more recently. And then, that whole sort of, day trading mentality, I think has been only accentuated by some of the social media platforms where you've seen, whether it be videos of TikTok or, these chat rooms and Reddit, it's created, certainly in the retail space, we've seen some pockets of speculation, and that environment again, we've seen accelerate in recent weeks in 2021. So, the other thing I think that's worth highlighting is if you look at the option activity. So the option activity from these retail purchases. So if you look at, for example, contracts of 10 call options or less, in 2020 that increased eightfold on 2019. And the one that I found fascinating was, if you look at the option volume days in history, 5 of the top 10 largest option volume days in history have happened in 2021. So in the last 3 weeks alone. So on top of that, we're seeing retail margin debt levels, they're back to record highs. And so, all of these are features of the current market environment, which, they're not sustainable trends.
So from that perspective, how are you positioning your portfolios?
It's a great question. And looking at the portfolio and how we approach that, I don't think, has changed, hasn't changed meaningfully in the recent past. And, I think we deal with that risk in 3 ways. I think the first one is that, in the funds, we have a reasonably sized cash balance at the moment. And, that's something that we will put to work as the opportunities present themselves. I think, secondly, VGI, we will continue to stick with high quality businesses. So we're very focused on finding businesses with strong, defendable economic moats, that's going to allow the business to earn high returns on invested capital over the long term. That's something that we've been very focused on since day one, and we'll continue to focus on. And you tend to see in more volatile times that those businesses, will tend to outperform. And then, look, I think the third point is that we're focused on companies that will benefit from long-term structural growth. So, I think one of the more amazing things that we've seen over the last 12 months with COVID has been this acceleration in structural trends that has been taking place for many years. But we've seen a pretty rapid acceleration, whether that be in online marketplaces, gaming, electronic payments. We've seen these corporations shift to the cloud, and even the application, of artificial intelligence is something that has really accelerated in the last 12 months. The best example, actually, which we talked about in the letter, is e-commerce penetration in the US. So if you look at e-commerce penetration here over the past 10 years prior to COVID, penetration went from 5% of US retail sales to about 15% over 10 years. Now, through that initial shutdown period that we saw in April here, the penetration levels increased the same amount that we saw over the last 10 years over a 12-week period. So we essentially saw 10 years of e-commerce penetration happen in about 3 months. So that's, the reason I raised, this structural growth dynamic is that's something that, we've always been highly focused on, and ensuring that the portfolio companies are exposed to those structural growth. And, that's something that I think has only become increasingly important over the last 12 months as we see, a continued acceleration in those trends.
I noticed that within the VGI portfolios, you've got on average roughly 20 to 25% of cash. You mentioned this wealth of opportunities in the global equity market. Why such high cash levels then?
No, it's, I mean, the way that we manage the portfolio at VGI Partners is we don't solve to an exposure. So our exposure is really an output of, one, what opportunities we're finding on the long side, and secondly, what opportunities we're finding on the short side. And the net exposure that we talked about today has actually increased, versus where we were 3 months ago. So we have put capital to work in some pretty interesting opportunities, and we continue to pretty relentlessly work at other new opportunities, a number of thematics and industries that we're working on at the moment. So that net exposure, where we sit in 3 months, 6 months, 12 months, that will really be a reflection of the opportunity set, and certainly where we think we can put capital to work, but put capital to work with a margin of safety, so that we're focused on capital preservation, and we're not putting ourselves at risk of permanent loss of capital. So that exposure is really a reflection of the opportunities we're seeing. We continue to find new opportunities, as I talked about earlier, and certainly that's been reflected in a higher net exposure more recently.
So on that, Rob, one of the new holdings in the Asia portfolio is Crown Resorts, a company well known to the Australian market. Can you take us through the thesis there?
Crown, as I'm sure everyone knows, it operates a number of casinos and hotels around Australia. They've got the exclusive license in Melbourne, the exclusive license in Perth, and then they've got additional casino license in London, and then potentially the rights to operate the second casino here well, not here, but there in Sydney. We've followed the Australian casino industry closely for a very long time. We were large shareholders in Echo Entertainment, from 2012 to 2015. That's now been renamed Star Entertainment, but that was a very large holding for us, and so we know the space quite well. We became interested in Crown following the share price decline that was initially caused by the concerns around COVID and lockdown, and we saw that opportunity as a pretty rare time to build a position in what we think is a high quality asset at a very attractive price. The lockdown, of course, understandably had a significant impact on the company's operations short term. But what we found at the time that we were buying is that we thought the market was extrapolating a pretty unrealistic scenario and implying that the asset was essentially permanently impaired. And so that's something we didn't agree with. We're very happy to take a long-term view. Certainly, if there's a short-term opportunity given to us, we're happy to take that long-term view. We also, at the time, we didn't have any concerns around the balance sheet. We thought that the company would be able to limit the cash flow burn rate after it moved to right-size the cost base. And then, we had another chance to size the position after, Crown faced, government inquiry there in New South Wales around its corporate governance practices. The inquiry was very public, had a lot of media attention, and, that sort of gave us an opportunity because it caused, quite a share price decline. We see a small probability that Crown loses that Sydney license. However, again, at the time, our analysis pretty clearly showed that the share price, where we sized our position, wasn't attributing any value to that Sydney casino license. So, at VGI, one thing that we're always looking for is investments where, we have upside optionality and where we're perhaps not necessarily paying for that optionality. And we thought that was the case when we took that position in Crown. On the inquiry, I think there's no question that they made some errors around corporate governance and compliance. And, we're of the view that the inquiry is likely to lead to, a significant improvement in corporate governance in Crown. And it's probably most likely going to make it a better and more sustainable business long term. So that was the thesis. I mean, the only other thing I'd highlight is, there was optionality, certainly at prices lower, where there's a number of suitors for the asset, and we know in the past that Crown has been approached by both a Win and Melco, and so that's not something that we're banking on in the investment thesis, but it's certainly another aspect that we thought provided some downside protection at those levels.
Another core holding in the portfolio, Rob, is Richmond. I think, like a lot of stocks over the course of 2020, it's run pretty hard. I think it's up about 80%. Can you take us through the thesis behind holding Richmond, and if you still believe there's plenty of upside left in it?
So Richmond is, essentially it's a portfolio of luxury brands, but when you actually look at the earnings and value driver of Richmond, it really is their jewelry division. And their jewelry division is two brands. It's Cartier and Van Cleef. And, we think that those two brands, they're not only, I would say, two of the strongest luxury brands, but they're certainly the two most valuable brands we believe in the jewelry space. And so Cartier is a brand with 170 years of unrivaled heritage. They've a long history of designing pieces for generations of royalty. And then, similarly, Van Cleef has over 110 years of very rich history. So, when we look at these brands, we look at a number of factors, both quantitative and qualitative, to determine the brand health and try and measure the brand health. And, there's a number of key indicators, things like resale value. If you look at Sotheby's and Christie's, both brands are consistently ranked in the most expensive jewelry sales. And then, we look at the Real, which is a luxury consignment store. They rank Van Cleef and Cartier as number 1 and 2 in terms of jewelry brands' ability to hold their resale value. So, we look at a range of data points, which gives us conviction that, Cartier and Van Cleef are the two most valuable brands in jewelry. And, the attractive thing about the jewelry space is there's actually a number of secular trends that is driving growth in the category itself. But then, on top of that, what we really like about it is, the branded jewelry space is still only 1/3 of the jewelry market globally. So that third has been increasing over time as branded jewelry such as Cartier and Van Cleef take share, but it's still only 1/3 penetrated. So we think that there's a long runway of growth, both in the category and also their ability to gain shares within the category. And so, when you look back over the past 10 years, Richmond's jewelry portfolio has grown at double digits revenue growth per annum over the past 10 years. And certainly we see the drivers that sort of drove that growth over the last 10 years to continue. The share price has certainly had a good run since the bottom, but, if you look at it sort of pre-COVID prices, it's less exciting. So we still think the shares are attractive here. And, we think they're attractive just based on the jewelry franchise alone. But, there's another piece, or there's a number of pieces to Richmond, which we don't think the market is ascribing that much value to, if anything at all. And that's, they're the leading e-commerce platform in Yoox, Net-a-Porter. And then, they've got multi-billion-dollar watch brands. They've got IWC, Panerai, and then, a number of accessory brands. They own Mont Blanc, they own Dunhill, they own Chloe. And so Richmond has a large portfolio of brands outside of the jewelry business, which we don't think the market is really ascribing much value to. So, we think it's a very high quality business. We think, they own two of the best brands of luxury in a part of luxury that has very attractive structural growth. And we think that, the other parts of the business are having very little to no value ascribed to it.
So that's on the long side. What about the short side? How has your short process been developing over the last 12 to 18 months? And is there any particular areas within the market that you're finding particularly fertile hunting ground at the moment?
On our shorts process, we've always been focused on what we call fads, frauds, and failures. So, that they're the key areas we've always focused. And we talked earlier about, this rapid increase in the penetration of online retail, and that is just one of the many accelerated trends that we've observed over this last 12 or so months. So as we talked about, the other one's been electronic payments, gaming. We've really seen this acceleration of the corporation moving their operations into the cloud. And this acceleration of structural trends, the reason I raise it is because the flip side to that is we've seen, an equally rapid acceleration in the creative destruction of some of these traditional business models. And so, we look back over the past 10 years at, what have been our best performing shorts. And certainly, that they have been the ones where we've been short companies that have been operating in structurally challenged industries, or, where we think the business model is susceptible to this creative destruction. That's certainly the area where, we've been focused, where we've, been more recently re-engaging on the short side, and where we're finding some, some pretty interesting opportunities. In terms of process, I think the only thing worth highlighting is that, overlaying this process, we've got this pretty acute focus on what we call identifying what we call red flags. And so a red flag, for us, it can consist of anything from aggressive accounting, masking an underlying issue in the business. It can be as simple as a key management executive leaving the company, a CEO or a CFO, or it could be, it could be an auditor change. But we run a process where we screen for those 100 or so red flags that we're tracking, and we can screen that, across every company that is listed globally. And so we run those screens on a weekly basis. And then on top of that, we've created sort of our own proprietary scoring system, which we've back tested, and it ranks those companies, highest concern to lowest concern in terms of, those red flags. And that's been a pretty robust source of ideas for us historically. We think it's going to be a robust idea for us going forward. And that's something that, we've focused on building out certainly over the last, 5 years, but accelerated, over the last 12, 24 months with, we've hired a data scientist over here in New York who's really taken charge of that process.
I know we can't talk current shorts, but maybe you could take us through a historical example that you've had in the portfolio before. Maybe take us through some of the filtering steps that you use to identify some of these stocks or some of the red flags that, allow it to appear on the VGI shortlist. Take us through how you go about shorting.
Yeah, sure. I mean, look, historical example I'm happy to talk about because we talked about it at the Hearts and Minds conference a couple of years back. But one of those was Hanes Brands, and that was a short that actually, it's a good one to discuss because that came out of this red flags process that I was just talking about, and that came out of the process for a number of reasons. It was on a large number of red flags. You had, key management leaving the company in relatively quick succession, both the CEO and CFO. We saw incredibly aggressive accounting. Cash flow conversion was very weak, and that was driven by, very aggressive recognition of accruals. That was driven by very aggressive add backs of restructuring charges. And then we found some other pretty unique red flags. One of those was the tax rate for the company. Every single quarter rounded perfectly to 5 decimals, and we thought that was very interesting and unusual. And so we went back and screened for that, across every listed global company, and from memory we found 1 or 2 other instances. So that was another red flag for us. There was a range of red flags that we found on the company, and that led us to really dig into the business in the industry. And what we found, typically when you see these red flags, is it is masking an underlying issue. And what we found at the business was it had been driven by a series of acquisitions, which were getting larger and larger. And we found that what was actually going on was that this activity and the aggressive accounting and the other things I discussed was hiding what was essentially an underlying deterioration in the core business. And they, just to give you a bit of a background, they will sell, undergarments, underwear, bras and things in the United States. But, their largest customer base is some of the large retailers here in the US. And essentially what we've seen is a shift towards private label. And so that was the underlying issue that we found in the business, the structural challenge that they had, and the red flags that we found, the company was clearly using to try and mask those underlying issues.
And last question, Rob, the 2 VGI portfolios are currently trading at a bit of a discount to NTA. What's the plan for 2021 to try and tighten up the gap?
The discounts is something that we're focused on correcting. And, I think looking at the listed investment companies, I think there's 2 ways really to lift the share price. I think one is is obviously through fund performance. And that's on that front, you know, I think the team is more engaged and determined than I've seen ever before. And, you know, we've got a 12-year track record there. So, you know, we'll continue to focus on that. But the second is to close the discounts. And, you know, to us, that really means keeping your existing investors engaged, but also finding new ones. And we've taken a few steps in that direction. You know, we've expanded our monthly update disclosure, which is hopefully more helpful. You know, we're participating in more conferences, and, you know, we're doing sessions like today, which is hopefully helpful in communicating with our shareholders. But a key part of what we're planning and what we're focused on for this year is holding more meetings with investors and holding more meetings with advisors. So to help us with this, we're in the process of hiring a number of business development managers. And that is something that, you know, is a real focus for us, certainly in the near term. I should also mention, you know, the unlisted funds are closed to new investors. And so, you know, any demand that is generated for the portfolio and the strategy would come through those listed investment companies, which should help to close the discount to NTA over time. So, you know, to sum up, you know, we know these things can take time. We want to do it sustainably. We've looked at a number of other funds that have been able to close the discounts and the strategies that they undertook. You know, and we're aware that we need to increase the dialogue. But, you know, most importantly, you know, we've got to deliver strong risk-adjusted returns.